Thank you very much. Good afternoon, all, and welcome to today's webinar on blockchain, crypto, and CBDC by Regent's University London. My name is Jacob Schmidt, and I will be the host for this webinar. I hope all of you are staying safe and healthy, and we appreciate you taking the time today to listen in. Before we begin, I would just like to point out that this session is being recorded, and a replay will be made available at a later point in time. The purpose of today's session is to hear an update on the fascinating subject of crypto, CBDC, and blockchain from leading experts from the central banks, the United Nations, wealth management firms, and academia in the US, Switzerland, Italy, and the UK. The views expressed here today are the speaker's own and should not be taken as an endorsement by any institution or deemed financial advice. It's purely educational. Before I pass over to the speakers, I have some housekeeping to make you aware of. We expect the session to last no more than 2 hours, with 60 minutes of short presentations, followed by a 60-minute panel discussion with Q&A. All of those dialing in are asked to stay muted and to leave their cameras switched off for the duration of the call. So if you have a question, please send it to us via the Q&A button, the chat function at the bottom of your screen. We cannot promise that we will have time to answer all of your questions today, though. Later on in this call, we'll be hearing from Massimo Buonomo, Jim Cunha, and Thomas Moser on CBDC, and Nicola Marinelli and myself, Jacob Schmidt, on cryptocurrencies. Later, Elias Bukrami will moderate a panel discussion in the second part. The president of the student union, respectively a gentleman deputizing for him from the student body, will say final words. Now over to the associate provost, Professor Lawrence Phillips, who will open the event. Over to you, Lawrence.
Thank you, Jakob. It falls to me the great honour to welcome everybody to Regent's University London, particularly our distinguished guests today. It might sound odd welcoming you to Regent's when the global pandemic obviously still keeps us online. But ongoing series like the Excellent Wealth Management webinars that this forms a part of are a reminder that universities are above all communities of learning and debate, and wherever a community gathers, that's where it exists and thrives. It doesn't necessarily need a physical campus. Lovely as our campus is, though, this time of year. So thank you again for our guests for generously giving their time to join our community, sharing their knowledge and insight to debate with us. Regent's takes pride in our overarching aim that our graduates should have the capacity to become global leaders. Leadership can take many forms within families, communities, as well as professionally. But there can be little debate that our distinguished panel today is easily a group of global leaders, and we're privileged to learn from their insights and their experiences. We're also gathering to discuss one profound change happening in the world, a topicality, if you like, underlined by yesterday's announcement about Bitcoin from the CBDC, in the context of many others which seem to have been accelerated by the catastrophe of the pandemic that we're all experiencing. Higher education, a global business, of course, is one such sector, which we are meeting through our sector-leading hallmark pedagogy that rests on the premise that a narrow education is not enough to navigate the present or the future, if indeed ever was. The complexity and contingencies of today's topic reminds us of that fact. We're certainly crafting new programs of study to help prepare our students for the present and the future in the global context, such as the recently validated BSc Business Technology and Entrepreneurship, an MSc in Data Science and Business, and MAs in User Experience Design and Content Creation. Alongside, obviously, as you need to do in today's environment, constantly refreshing our established programs that have proven their relevance over time. We're proud to welcome you to the latest of our wealth management webinars, and above all, again, to take a special kind of pride in our students who are joining us today as well to hear from our distinguished panel. I'd like to thank you all again for joining with us to invest in their futures through today's panels. And to hand back to Jakob now. Thank you very much.
Thank you very much. So we start our session of keynote speakers, the three keynote speakers being Massimo, Jim, and Cunha, and Dr. Moser of the Swiss National Bank, with Massimo, who will give us an overview of the global CBDC market. And over to you, Massimo. Please share your presentation with us. Thank you.
Okay, thank you. Let's see the presentation here. Hold on a sec. Here we go. And like that. Okay. So today we're going to talk about the central bank's digital currencies. Just one quick disclaimer: what I'm going to say are just my personal opinions and not of my organization. Now, what we want to focus is on the two different models of CBDCs and digital currencies. One is the one-tier model, where the digital money is to be transferred directly from the central bank via the social security system to a single person. So in this case, the social security system holds, as we know, all the updated information of the persons. Because of COVID-19, the money transfers to be done to the people who need them the most, the unemployed, could be done directly with digital currency transfers from the government via the social security system to them. So in this case, we have direct payments via the blockchain, which allow the money to go fast to the people who need them the most. Then we have the second model, the two-tier model, where the digital money is to be transferred via intermediaries, mostly banks, to a single person. This is the model to be adopted in China, which is being proposed in US and in other countries. Generally speaking, banks are not much in favor of the introduction of a digital currency, because they would suffer the most if the one-tier system is adopted in the longer term. However, the companies worst off because of the introduction of the digital currencies will be the likes of Visa and MasterCard. The processing of transactions in the future will not need credit cards, but only digital currency wallets. And we're going to see it. What is the impact of CBDCs? The impact is certainly positive for consumers, because in the current interest rate environment, the only advantage of having a bank account is that it enables digital payments, because there is no interest remuneration in bank accounts. So there is a sort of crowding out of bank deposits. There are also many costs related to having a bank account, especially for every single transaction to be done. There is also lower security because of breaches from hackers, and there are fees to be paid for electronic transactions using credit cards. So in fact, the use of digital currency eliminates the need of a bank account. Why? Because all you need is a digital wallet, which allows you to hold digital money and makes you pay the bills using the mobile phone without even using the credit card. There are no fees to be paid to credit card processing companies like Visa, MasterCard, even SWIFT, and no fees to be paid to banks for bank money transfers or just for holding a bank account. Now, BIS, Bank of International Settlements, made a survey for the reason for central banks to issue a general purpose CBDC. And there is a list of them. The main reasons are domestic payments efficiency and payment safety. There is also the issue of financial inclusion, which is quite important, and enhancing payments for the retail CBDCs, and then financial stability and control of monetary policy. Another issue which has been raised by Chinese central bank, is to work together to ensure that CBDCs are compatible with each other, the issue of interoperability. Now, Jim is going to talk extensively about the US case. I'm just going to touch on it. And there's the Digital Dollar Project, which is a partnership between the Digital Dollar Foundation and Accenture to advance the exploration of a digital dollar. The main features are the following. First of all, we're going to talk about a two-tier model where digital dollar is just a tokenized form of US dollar. And then the digital dollar would operate alongside existing fiat currency, a commercial bank money, and also will be distributed through commercial banks. And of course, the digital dollar will not impact the Federal Reserve's ability to affect monetary policy and control inflation. Then there is the DCEP, which is the most famous nowadays digital central bank digital currency, which is the digital currency electronic payment to be issued by People's Bank of China. This is a national digital currency that has some of the features that we discussed before. First of all, it's exactly the same as paper money, but just in a digital form. And then it's being transferred to, between users even without an account or without a mobile or internet network. But if a user has a mobile phone and has a wallet in it, the digital currency can be transferred to another person, just placing the two phones one above the other in physical contact, the NFC technology. And also, the use not only of blockchain technology, because currently the technology would not be able to handle transactions volumes in China, such a big country. Now, there are some points about DCEP that are worth mentioning. First of all, this is a model of two-tier model where central bank will be distributing the CBDCs to consumer-facing firms, and then those firms, the intermediaries, will issue it to the public. The firms should include the tech giants Alipay, WeChat, and also the leading banks in China. CBDC would not require a linked bank account and is perceived to be a sort of horse race in China, where the leader will win the entire market. And there still are some concerns about Diem Libra. Now, the main aim of DCEP in China is to maintain control of monetary supply. Because in this case, as we know in economics, the digital currency would replace M0, cash in circulation, rather than M2, which is impacts only credit and monetary policy. Also, an important point about DCEP is that it cuts the cost of circulating traditional paper money. And also, digital assets must be under central bank oversight to prevent foreign exchange risk and to contrast a currency like Libra, which will be a dominant player for digital payments and a potential channel for money laundering. Now, there are some internal reasons as well that have been mentioned by the Central Bank of China. And this is the point is that the aim of this app is to maintain financial stability should something happen, they said, to Alipay and Tencent WeChat Pay, because these two private platforms dominate the Chinese digital payment system market with 98% of it. So if something negative happens to them, that would definitely bring down the financial stability in China. And that is why, another reason why China has been pushing very hard to introduce this app. So in order to provide a backup for the retail payment system, China has introduced this app. And also, finally, in Europe, we have the e-krona. E-krona is being introduced by Sweden. The features is, if we look at the Swedish market, only 13% of the population paid for its most recent purchases in cash. So 87% of transactions are done electronically. But that has an impact for Swedish central bank, because first of all, small businesses in Sweden have completely switched to cashless payments. This is a sort of cashless society. But the growth of the Swedish digital payments market means a situation in which all means of payments are issued and controlled by private agents. This is a concern for central banks, because of course that might have an impact on monetary policy as well. Then Sweden e-krona project aims to introduce a new currency, digital currency, in 2021, and the digital currency would not entirely replace the physical cash if and when it's created. So this is a sort of a roundup of the main issues of the CBDCs, and then my presentation is finished. I hand over to Jacob.
Thank you so much, Massimo. I think we're now passing on to our next speaker, being Jim, who's going to give us the perspective from the other side of the pond, from the US. Over to you, Jim. Thank you. You need to unmute.
There I am. My apologies.
Yeah, very good.
All right, let me get back to presenting. I assume you can see that, correct?
Yeah.
Very good. Perfect.
Okay.
Thank you.
Yeah. So first of all, thanks for the invitation. Just a bit of context. I've been at the Federal Reserve for 36 years, always in payments and technology and security. So I'm not an economist or a regulator. I'm really approaching this project from a technology perspective, but it's a real pleasure to be here. And I'll talk about what's happening in the US. One point of clarification, Massimo did a good job of talking about some of the key initiatives, but I do want to clarify that the Digital Dollar Project is not the voice of the Federal Reserve. It is some private citizens, as Massimo pointed out, that are working with Accenture, and they're trying to put forward a particular model that they think would work for the United States. But that is currently not our policy. That's just one voice of what might be possible. So I just want to clarify the difference there. And so why now? Massimo pointed out there's a lot going on across the world. I'll point out just one other point on the very bottom of this screen, which is why are we focusing on a retail CBDC at this point? We started that project just this past year in 2020. But as part of our COVID relief packages, there was actually some potential laws that were introduced that would have forced the Federal Reserve to create accounts for citizens and issue CBDC. That was one of the models that Massimo mentioned as a direct model. Those were not successful, but it does show you how significant the interest is, even amongst lawmakers, that the Federal Reserve understand what's possible. And so my goal really is to understand the technology and to make sure the Federal Reserve is positioned to build the CBDC platform if either we decide to do so or our Congress tells us to. So we have not made decisions yet. We have no mandate to move to production, but my goal is to learn about what's possible from a technology perspective. So to do that, we've got two tracks of work. We call these Project Hamilton. In the first track is that we're working jointly with MIT, specifically the Digital Currency Initiative. The DCI has been studying cryptocurrencies and CBDC for the past 5 years. Actually, some of the core Bitcoin developers are part of the DCI. So these people are, amongst the best in the world in thinking about CBDC from a technology perspective. It's joint research, so we're jointly coding, we're testing, we're designing systems. And our goal is to build a research model to determine what's possible. We are technology agnostic. And so while we are looking at various blockchain solutions, we're not necessarily going to tie ourselves to a blockchain solution per se, but we're going to go where the technology and the research point us. We have two phases of work. The first is to build the core engine. So think of this as the software that will mint the money, store the money, move the money. It's really equivalent of Bitcoin itself. It's a very core system for making money and moving it and storing it. And we have a goal of trying to meet some very, very stringent performance requirements because the US's model would look different from some other smaller countries as far as what we expect. So our goal is to build a system that can process, many tens of thousands of transactions per second, at least on par with the major credit card network. It has to be safe. It has to process transactions in a matter of seconds and resilient to cyber attacks. So we're almost through coding the system now. We actually have a couple of different models we're working with. And our goal is to test those over the next couple of months. And then we're going to publish results with MIT. We're going to publish technology results, but also create an open source license for the code. So anybody, much like Bitcoin itself and many other open source software, our goal is to make our research open to everybody. So people can contribute to it. They can take it and build their own derivative products. They can tell us what works well, what doesn't work well, so that we want the whole world to learn from what we're doing here, which we think is some leading edge work within CBDC. Because we think some of the challenges we're going to have aren't yet solved by the technology that's out today. Then we'll move to multiple phases of work. Phase two is that we're going to code and test different options for policy. We're not setting the policy. We're just looking at certain challenging policy questions that exist to say, what happens if we try to code them into our system? And we have two goals. One is to make sure if we add software to the existing platform, we can still go as fast. We can still meet our original metrics of multiples of tens of thousands of transactions per second, finality in under 5 seconds, et cetera, and still be resilient. But also, many of the policy questions create challenges for the technology. Can we also order privacy? Can we have a distribution model that works in a way that the technology can help inform the policy? And so that work will take another year or two. So our goal is to add to the technology and try to solve some inherently challenging policy or design questions. The next track of work is just the Fed. This is not involving MIT per se, but we understand that there's not just one way of building a CBDC. So we're doing a comparative analysis. We're going to take 40 or so different platforms, both publicly available and private, and compare them. So for instance, we would take many of the blockchain derivatives, Ethereum, Hyperledgers, Bitcoin itself, the platform Diem is built off of, compare all of those to see whether they can meet our metrics, but also private sector actors. So there are solutions out there that companies have built that say they can meet our needs. So we're going to look at those as well, and then compare them all and say, what are the top couple of platforms? Then we'll bring them in-house and test them against our test metrics to see how they compare against what we built with MIT. So this is not really a buy-build decision process. We're just trying to make sure we're as informed as possible about what the technology can do, so that if we either decide to act within a few years or are directed to act by Congress, we're ready. So technology research, but the goal really is to prepare ourselves and also to see, are there some areas where the technology is just not ready yet that we can help move that research forward. On this last piece here, we're not really planning on publishing our analysis on this track B. It's really for our own internal education. Now, there are many design questions and policy questions. I'm not going to really get deeply into these, but what I don't want to do is, even though I have no direction to go to production, I want to build something that's robust and that can handle the future needs. So I don't want to build something that is just doing it the old-fashioned way, or in Boston, as we say, I don't want to pave the cow paths because then I'll get the same old streets. And I'm sure in London, there's some cow paths that have been paved as well. But we really want to make sure we're looking at things differently. Policy decision impact technology, but sometimes technology can help influence policy. these are some of the major questions that we think about, and others around the world and with other central banks are thinking about, privacy versus traceability. Massimo mentioned the distribution model. Does it come from the Fed, or do I go through intermediaries? Are they banks? Are they non-banks? Cross-border is a major issue that people believe CBDC can help save. One of my major projects is financial inclusion. Can I take those people that are either unbanked or underbanked, and can CBDC actually have to solve some problems for them? So as you can see, there's plenty of major issues here. We don't have answers to these. I'll quote my chairman, Chair Powell, who said, in order to answer these questions, if we were going to think about moving towards a CBDC, this would take significant consultation with the industry, with not just the financial industry, but businesses, trade organizations, consumer groups, because so many people are impacted by a decision here. You've seen some of the consultation that was done by the ECB, by the UK and others. There's been a need to do that. We don't have these decisions. So what I'm building is I'm trying to build a system that's flexible enough to answer any of these questions and to be adaptable to take any model based on how these questions are answered. So with that, I will get out of my screen and then pass it over to Thomas.
Thank you very much. Thank you very much, Jim. So, Thomas Moser, Swiss National Bank. I'm an economist, but I have seen in the last 10 years, and especially with central banks, the last 3 years has been very exciting, because suddenly payments and banking operations in central banks has become the most exciting place to be. Before, everyone wanted to be in economics, in the macroeconomic monetary policy section or in the financial stability section. But right now we get the best talent and the most exciting work in banking operations and payments. And it's partly because, as Jim said, because suddenly we have technology or people coming from technology looking at payments and money from a very different perspective, and giving us new challenges and new ways to look at things. For me, a very interesting moment was a couple of years ago when someone said to me, when I make a payment, let's say from Zurich to London, why is it more complicated and more expensive than sending an email from Zurich to London? Because it's just a message that's sent. And I think that was very enlightening to me. And that's exactly the question. Why is it so complicated, what we have nowadays? Now, I will talk about our project. We called it Helvetia. It's not a retail CBDC project. That's the one that Massimo and Jim have been talking about, but it's a wholesale CBD, meaning there would be a CBDC not available to the public at large, but only to selected financial institutions. And in our case, we didn't really come up with the idea, but we were kind of forced into this question by the developments, again, from a technological point of view, from the Swiss Stock Exchange. On the left here, you see how the Swiss Stock Exchange works nowadays, and I have to tell you, it's an extremely modern system. So that's already cutting edge. But they intend to open up a digital exchange going live this year. The only thing they are waiting for is the license. Technically, they are ready. And you can see the difference here. On the left, you see if you buy some securities, you have a trading platform. Then you go on a clearing platform. It's a different platform. And that can be anything from 1 to 2 days later. Until it's there.
My apologies, Tom. Tom, you're not sharing a screen.
Wow, okay.
And can I ask perhaps all the guests here to switch off their cameras? Only the speakers. Thank you very much. If you can switch off your cameras. Thank you.
Sorry for that.
Mr. Brian Guest and Ashley Eversole, please. Thank you.
Okay.
Thank you very much.
Thank
you. Yeah.
Okay, sorry for that. So on the left again, you see how the Swiss Stock Exchange works nowadays. And on the right, you can see how the digital exchange is going to work. And the digital exchange on the right is based on a DLT, distributed ledger technology. Some would call it blockchain. Some, I guess, blockchain enthusiasts would say it's not really a blockchain because it's a permissioned blockchain. It's not open like a Bitcoin or Ethereum. So you have to have a permission to be on that blockchain, and it's a relatively small group that's on that chain. But so on the left again, sorry, you see that you have 4 different platforms that are involved if you are buying securities. You have a trading platform, the SIX Swiss Exchange, then you have a clearing platform, and then you have a security settlement platform, and then finally the cash settlement platform. And that takes usually up to 2 days until this trade is through and finally settled. On the right, you see the how easier it will get. Basically, you have the trading, and then everything happens simultaneously. The clearing and the settlement takes place at the same time on the blockchain. So that's one of the efficiency gains you get. And then there are others like post-trading processes that are simpler. But that's what the Swiss Digital Exchange is going to do probably from mid of this year. Now, the way they will do it, and one issue is we do not have a CBDC in Switzerland. So what they will do is they will have their own stablecoin, the SDX stablecoin, and the way they do it, they will get a bank account. So on the right, what's called here SIC, that's the traditional system. On the left, again, you have the blockchain, the SDX. So on the traditional system, they get an account with us, like a lot of banks have or financial market infrastructures can, and they will use their bank account with us to tokenize money. So it's like other stable coins. One difference is that the asset backing the stable coin will be central bank money. Some people call that a hybrid CBDC, but I would not call it a CBDC. I would call it a stable coin just backed with a central bank account, which makes it extremely safe and secure. And then you have this SDX node, and they will issue that money on the SDX blockchain, and that's how they intend to go live, or how they will go live mid-year. So for us, the question was, do we want that, or do we want to have central bank money on the blockchain? And the question is an old one. Usually the answer is, if you have a financial market infrastructure that is significant and of systemic importance, then you would want to have the cash settled in central bank money and not in commercial bank money, because it gives you another level of security. So the question then is for us, how do we do that? And the 2 red squares that you have here on the right, these are the 2 proof of concepts that we did, and that's what we call Project Helvetia. So one of these proof of concepts was that we issue ourselves wholesale CBDC. So we put central bank money directly on the blockchain. And the other one the other proof of concept was that just linking the traditional system, the RTGS system, with the blockchain, that's also how you can basically get trades settled in central bank money by just linking the 2 systems. So the first proof of concept was the wholesale CBDC. I don't go through all the details, but you basically see the difference to the case of the stablecoin. If you now look at the blockchain, the SDX on the left, then you see now the Swiss National Bank, the central bank, has a node itself. And the Swiss National Bank will issue directly on the blockchain central bank money, wholesale CBDC, to the banks participating on that blockchain. And so the securities are paid with central bank money. The other proof of concept was, as I said, just linking the 2 systems. So you have on the blockchain only the security settlement, and on the traditional SIC system, you have the cash settlement. Now, when we compare the 2, and this is the project that's already finished, you will find documentation on that on the BIS website, because we did that together with the Bank for International Settlements Innovation Hub, also with the idea to share the results with the central bank community. If you compare them now, on the left, the wholesale CBDC, Of course, the benefits there are that you get the full functionalities of a blockchain, of a DLT, atomic multilateral settlement, and you can also integrate smart contracts and smart assets with that solution. The negative side on the bottom is that you need to think about a lot of things. One would be exactly what's the responsibility of a central bank. If I go one slide back here, you see that on this DLT, and in this case it's a quarter.
Thomas, sorry to interrupt. I think we can't see your presentation. There's something else happening. Can you just double check that you take control of the screen? There's something else happening. Thank you.
But you could see it before.
Before we could see it, yeah. Now we can see something else. At least I can see something else.
Yeah, somebody else has shared their screen, so it took over Thomas's slides. So Thomas, just share again and we'll see it.
Okay.
So no one else, please, to share, only Thomas. Thank you. There we go, yeah.
Okay.
Thank you very much.
So here on the left, on the bottom left, you see this notary node. That's how double spending is checked on that DLT. And the question, for instance, is who is responsible for that notary node? Is it the central bank? Is it the provider of the DLT and so on? So there are a lot of policy and governance questions involved with this solution. There's also the question of what does it mean for money markets? Because you basically have a segregation of liquidity. You have banks that need to have now liquidity in the form of CBDC and also in the form of the normal central bank deposits. What does that exactly mean? So a lot of questions still involved. If you go with the POC2, where we just link the traditional system with the DLT, of course, that's much easier because there are no real policy issues to solve, no real governance issues to solve. Everything stays the same for the central bank, at least. The downsides, of course, is that you cannot take advantage of the functionalities of the DLT. So just an outlook here, what we are doing right now, we are going now into stage 2 of this project. We do 2 things now. One is that we go really end to end. One of the nice things is because we could work on this SDX DLT, this is not just a research project. This is a platform that is going to go live mid-year. So everything is there, everything is real. And now in the next phase, we also go into the core banking systems, look how that would have to be solved, all the details with a CBDC, and we go also into our own balance sheet and really solve it end to end, that we would be basically ready to go live if we would decide so. And the other thing that we do is a broadening, that we are cooperating with another central bank to involve some cross-border wholesale CBDC payments and also look at that dimension. As I said, you will find the report on the website of the BIS. There are also movies how that works on YouTube. So if you're interested in that, please go to the website and check it out. Thank you.
Thank you very much. Now over to Nicola Marinelli of Regents University, who is going to speak about the cryptocurrency market, in particular Coinbase. So over to you, Nicola.
Thank you very much. Welcome, everyone. I will talk a bit about recent facts and trends about cryptocurrencies, and also maybe my take about why central banks are now so much interested in developing digital currencies. We've heard already a lot of the motivations. I will give you my take on this. Where do I get the information that I'm giving you today? Basically from several surveys, in particular 2. One is from the University of Cambridge, and the other one is which has already been mentioned, from the BIS, which was issued in February. And finally, also a lot of the charts that you will see are coming from the Coinbase IPO, which was launched last week. So they had to submit a prospectus, and therefore we have an insight into this market. Why are we all here today? Why there is so much interest in this? It's undeniable that the interest in cryptocurrencies is because of the market cap. Now, I took these slides on the 17th of April, so a couple of days ago. Now, I think it's below 2 trillion, the market cap. So this is a testament to the volatility of these cryptocurrencies. And in particular, you can see that the first two, Bitcoin and Ethereum, represent basically 70%, sometimes even more, of the entire cryptocurrency ecosystems. And now you can have more than 3,000 different currencies. In particular, what is the difference between Bitcoin and Ethereum? Without going into the technicalities, Ethereum allows you to build applications that are more complex because it's based on a script language that allows loops and is technically called Turing complete. Bitcoin isn't, but Bitcoin was the original first currency, so that's where most of the trading takes place. This is from Coinbase, and it's just telling you the same story, but in terms of historical trend. And as you can see, we have a log scale here. That means that on the left side, each step is multiplied by 10. So that tells you not only how big the bullish market has been on Bitcoin, but also how big the volatility is, both in good days and in bad periods and good periods. I borrowed this table from Morgan Stanley because we will touch briefly about what are the uses of cryptocurrencies nowadays. And you hear a lot, and as a payment system or democratization of financial services. The reality is that most, if not all of them, are for the time being just speculative assets. And Morgan Stanley has actually produced this table to basically put forward the idea that maybe Bitcoin will become, or is already become, an asset that is now able to get into traditional portfolios that are managed by asset managers and private banks. And they, in order to do this, they compare with gold. You might have heard the idea that Bitcoin is like digital gold. And the reason why they compare that is because gold and Bitcoin don't really have any productive use. Gold, apart from jewelry, is not used in any production, but it's been around for thousands of years. And Morgan Stanley has just showing us that the various gold physical exchanges, ETFs, they amount to more than 11 trillion in February this year, while Bitcoin market cap was at the time 800 billion. And so as a percentage of gold, it was only 8%. And something similar is happening in the average trading volume of the two things. So if you think that Bitcoin will actually become a stable asset that can go, and maybe Jacob will talk about this into traditional wealth management, then there is space for its price to increase even more, independently of the actual use of Bitcoin as for other means. In fact, Morgan Stanley noted, and this is something that I've taken from the Library of Congress of the US, is that in 1933, this is an executive order of the president, gold was banished. You had to give all your gold to the Federal Reserve because they needed, at the time, in order to issue money, at least I think 40% had to be backed by physical gold. And so this order stayed until 1974. So until that time, it was illegal to basically hold gold as an investment. Something that we might in another way compare to the current status of Bitcoin. And so if Bitcoin is, acts like gold did since the 80s, then again, it's another motivation why it might become a traditional asset in the future. It's not only cryptocurrencies. We are all here because you have already heard about this. This is a non-fungible token, so another kind of crypto asset, digital, usually connected to digital art or similar things. And there is a hype in this market as well because the piece on the top right sold last month for $69 million. The nice cat with the rainbow sold for $600,000. So it's evident that this is one of the main reasons why we're all talking about this. But it's not the only one. We will see what actually drives the motivation of central banks, which has already a little bit come up so far. I think this is an interesting chart from the University of Cambridge, in which you have the different ecosystems of the crypto assets, and you have the two big ones, Bitcoin and Ethereum, the smaller crypto currencies, and inside the various players, so the miners, the developer of the applications, the storage providers, the wallet providers, the users, the crypto-only exchanges. And it's interesting to look at this graph because you understand a little bit better the connection among all these players, but also because you might want to ask yourself where the descriptions that we have heard from our guests would fit. Will the central bank digital currency develop, each one develop their own small ecosystems? Will there be interoperability among them or not? This is questions that need to be answered. Yes, depends on how effectively they will be developed. On the border, on the yellow border, you have the institutions that are basically a bridge between those ecosystems and the external world, like the exchanges that, like Coinbase, not only trade crypto assets, but also fiat currencies and other assets. Where are the companies, most of the companies active in the crypto asset industry, where are they based? Well, it's not a surprise to see that most are coming from North America and Asia, and in particular China and India. And in China, actually, I read the other day, 64% of the entire world mining is based in China these days, because it's something that there are areas there where the electricity is cheap because of hydropower. In Europe, UK, Switzerland, and France are the most active countries. Another question that you might ask yourself, and you want to give a number, associate a number with, is how many actual users are there? Why, are we developing digital currencies that are going to be used, or are just going to be a niche? A lot of the talk these days in fintech is about democratization. Well, there are several studies that have been conducted over the last few years. For example, the Bank of Canada, the Financial Service Agency from Japan, ING Bank, and several others. But at the end of the day, if you pull out the percentages, we end up always between 2 and 9% of the population of the developed countries as of 2018, which was around 1.3 billion. And so we have, what I call a lower bound range of between 28 and 126 million unique users in the world, which is a lower range because it was in 2018, and probably DI will have more users, and also because it doesn't take into account developing countries. And in terms of what has happened since 2018 to today, to the number of potential users, we can take a cue from the Coinbase prospectus, which shows the verified users on their platform. And in 2018 and 2020, basically they almost doubled. And that's interesting. Okay, they are not unique users because each account holders can basically open more than one account, but that's the trend that is being very steady and in one direction only. Another interesting thing to kind of see what are these users actually just opening an account, or they actually use the Bitcoins or other crypto assets? Well, if we look at the monthly transacting users, so the users that, according to the prospectus, trade or act at least once a month, the number that we have at the last quarter of 2020 is basically the same that we had 2 years ago at the beginning of 2018. So yes, there has been a big increase, maybe interest coming from different sources, the price increase, but not every one of these new current clients is actually using it on a monthly basis. And also, who are these users? According to the University of Cambridge, most of the users are individuals, and then we have business clients. But the definition of business is basically crypto asset hedge funds and online merchants. And according to Coinbase,
the institutional customer are hedge funds, trading firms, financial institutions, family offices, and more recently corporations. And you might relate this to the announcement that, for example, Tesla did a couple of months ago about they bought some of they put some of their cash into Bitcoin. They might accept Bitcoin for the purchase of their cars. So basically, as of today, the vast majority of the institutional customers is not there to use Bitcoin as a payment system, but mostly as a trading asset, as a speculative asset. Again, this is an interesting take from Coinbase, in which shows that in 2018, the trading volume was dominated by retail, while fast forward to today, basically, it's the opposite. The 2/3 at least of the trading volume is coming from those institutional clients. And the reason they give is basically Bitcoin, we know, is capped. Is a deflationary currency or deflationary assets. And so, according to Coinbase, these institutions are trading or are using this as an hedge against inflation. And maybe you can believe it or not, but maybe you can relate it with the recent weakness in government bond prices and increasing interest rates because of possibility of in future inflation. But speculation remains the major use, as I've mentioned several times. And another cue you can get is, Coinbase is saying we provide secure loans, leverage loans to customers in order for them to trade with leverage. And according to the University of Cambridge, which also takes into account many other exchanges, the median amount of leverage is 3.3 times, which with the volatility of these assets is a major leverage, in my opinion. And something that was mentioned from other presentations is that we also have, I don't want to talk too much about the risks of currencies, but just mention this chart, which shows that these are the total funds lost and the number of breaches that lead to total funds lost, which basically these days is kind of a forgotten theme. But in 2014, we had a spike. I think it was related to what at the time was Mt. Gox. At the time was one of the most important exchange in Japan, which basically from which $500 million worth of Bitcoin were stolen. But in 2018, we had amount of losses that almost probably dwarf that loss at the time. But now, and to finish, I just want to give you my take on why we have this interest from central banks now. I mean, we have already seen very good and clearly true motivations from our guests. I have only one big explanation behind it. Well, I don't think it's this one. So there are many research that show that especially during the COVID situation, payments are shifting to digital. So in this chart, you can see that the physical instruments are decreasing and the digital instruments are increasing. But it's not clear to me why just this would force. This is a trend that has been around for some time. And also it can be easily managed by the existing technology. You don't need to issue a digital currency just for this. We've already seen that Sweden was mentioned, the disappearance of cash, a cashless society. But there is a paper, and I encourage you to see it, is online from a CEPR, and actually written by researchers of Swedbank and Riksbank and the Norwegian Central Bank, in which they show that this decrease in currency circulation is just something that is happening in Sweden and Norway for peculiar reasons associated with those two countries, but it's not something that you observe in the rest of the world. So again, this cannot really be the motivation. This, as already been mentioned, is the real motivation. Facebook and its project with Libra. In fact, this is the chart from the Bank for International Settlement, in which they ask the central banks of the world, if they are involved in CBDC work and how far they are, and so on. And as you can see, in 2017, there were like 65% on the left side of the chart. 65% of central banks were kind of engaged in some way. Then in 2018, the first plan for Libra, later reduced to what is called Diem now, started to emerge, and the plan, you know, and also after that we had the reaction, partly of due to this of China with the digital yuan, which has already been mentioned, and but what really scared, I think, central banks and governments around the world was that if a platform like Facebook or similar, could be Amazon, could be Google, could be a similar company with billions of users, allows an easy to use stable coin, so that has not the same kind of volatility of the other cryptocurrencies, to be used for, you know, to pay for goods and services with one click, you can have virtually overnight the creation of an alternative payment system that is replacing the current fiat currencies. And the loss of sovereignty and the loss of the seigniorage will be massive, especially for developing countries, but also for, you know, the developed central banks. And in fact, and this is my last slide, I would like to point you to this chart from the BIS, in which they ask the central banks how important the various motivations are for issuing a retail digital currencies. And as you can see, the red dots are for the developed countries, and the blue squares are from developing countries. The red dots are always, apart from the last two motivations, below free, and free is important. So where do they become important? Only for payment safety and robustness, and for others motivations. So I ask myself, what are these others motivations? And if you dig a little bit in the report, and this is what they mention, is a CBDC could have others, means that a CBDC could have maintain a country's monetary sovereignty in the face of digital dollarization, or provide a public alternative in the case of a widespread adoption of pivotal digital currencies. So this is the main concern for most central banks, and this is why we are here now and why the works are so advanced, I think. So that's all for me. Thank you very much for listening.
Thank you so much, Nicola. So now it's my pleasure to tell you about the wealth management perspective of things. Mr. Brian Guest, if you could switch off the camera, that would be appreciated. Thank you. And I'm going to share now my presentation, which is here. Okay, and we're going to do here. So I want to talk about the role of cryptocurrencies in wealth management portfolios. So just to give you here the perspective of the background, I'm an academic here at Regents University. I've been with Regents University for many, many years, basically since 2002. I'm still young and fresh and excited. And secondly, I'm also the chief investment analyst at a wealth management firm called NLP Financial Management here in London. I would like to point out that this is my personal opinion, and this does not reflect NLP Financial Management's or any other's opinion here. But I would like to give you the kind of view of what cryptocurrencies play or could play in a wealth management portfolio. So the research question here is really from an academic as well as a practitioner's point of view of what can it be a cryptocurrency like, let's for simplicity say Bitcoin, but of course we know there are many others. And I'm asking here the question, and I have two hypotheses. The first one, the null hypothesis, as you know, cryptocurrencies are too risky, they're too volatile, they're unpredictable, they're not investable. That is what many people say, and if you're in the echo chamber of my generation, the kind of people in their 40s and 50s, they probably would say that. In 60s, they would say, it is not investable, it's all rubbish, it's all criminal, and so on. And then there are my students, and that's what I really like about being an academic, because I get out and I get out of my comfort zone, and they tell me, listen, there's a big world out there, and we heard this already from the previous speakers. It's a huge world, it's an ecosystem. Sometimes I say it's a parallel universe. It is not a parallel universe. It's part of the universe. We are just in echo chambers. Hence, I say the alternative hypothesis is that cryptocurrencies can be allocated under certain conditions. And I would like to answer this research question as follows. The first one here is that I give you an overview of the crypto market quickly, then talk about what practitioners are saying and doing, then the literature review from academic point of view, wealth management's perspective, valuation, risk management, how to invest, and then what the role could be in my conclusion. And I'm trying to be short because I want to give us all a lot of opportunity to discuss it and to ask you as participants here to ask questions. So the first one, we heard already a lot about that. It's a total market cap of over 2 trillion. It varies a lot every day because Bitcoin, which is over 51% of the market cap, is very volatile, but so are the others. But it's now 2 trillion, and 51% of these 2 trillion, so over 1 trillion, is a market cap of Bitcoin. What I don't show you here is the daily volumes. The daily volumes are massive. So there are massive amount of transactions being done every day and amounts of money being moved. Secondly, there are thousands of coins and tokens, and without wanting to go into this discussion here, what is the difference between the coin and the token? You know, the token is something that actually lives off an ecosystem, like we heard Bitcoin or Ethereum or whatever it is. And there's a disagreement of whether it's 9,000 or 5,000 or 2,000. And I think it doesn't matter. I think it's massive, but it is highly concentrated with a small number of really coins of leaders. And I compared a little bit to the internet of 20 years ago, when we had a lot of players and only a few survived. So we don't know who's going to survive, but we know there is something there. Then there are lots of exchanges. Coinbase is one of them, which went public last week, and we have lots of others that are all private and so on. But people are involved in them. They fund them. They put money into that, hedge funds, and I come to that in a second. So it's a total new ecosystem consisting of all of these coins, tokens, service providers, traders, investors, innovators, and so forth and so on. It's huge, as you know, and there is a paradigm shift in finance in that we need to look into that. So just what I call here some kind of perhaps literature review, okay, what the practitioners are saying and doing. And I've been looking at this for as a researcher, as an academic, both and as a practitioner, and I've looked at what is really happening out there. So Bridgewater, the 250 billion massive asset manager, in their report on the 28th of Jan of this year, Ray Dalio and the second researcher over there, in a very interesting report, said a few things that I want to point out here. First of all, he says Bitcoin is one hell of an invention. I like that because I teach not just wealth management, I also teach innovation and entrepreneurship. It's very entrepreneurial. So that's why many of my students like it. Secondly, I'm saying in this report that Bitcoin has succeeded in crossing the line from being highly speculative to probably being around and having some value in the future. That's very interesting. Okay, and he's saying it about Bitcoin. He's not saying it about blockchain or about the market. He's saying it about Bitcoin. And thirdly, with regards to valuations, he says here, Bitcoin looks like a long duration option on a highly unknown future where you wouldn't mind losing about 80%. And I come to this question of how to value this and what is it? Because the real question is really, if we look at Bitcoin and cryptocurrencies, what are they? What kind of assets are they? Are they currencies? No, they are not currencies. Are they assets? Yes, they're assets. They're some kind of assets. But if it's an asset, or even if it's a currency, we need to think about how can I value that. As a finance guy, as an economist, and as a wealth management practitioner, my question is always, what's the value of that? A few other comments here. Rathbone, in a research a few years ago, talked about the disruptive nature of blockchain and cryptocurrencies. We understand it, 2017. Then they said with regards to Bitcoin this year. There's a problem with legitimacy and visibility, so still critical. Pictet in a report said blockchain technology provides grocers with tools to capture. So they focus more on the blockchain side. So if you want to be safe as a wealth manager or investment firm, you focus on the obvious, that blockchain is something in the technology that has value. You're not having really an opinion on Bitcoin because, as we know from Jamie Dimon's, JP Morgan's chief executive a few years ago, you might say something and you might regret it because the market then does something very different to you. Very interesting, the UKIF wealth manager, investment manager, Rafa, which has 25 billion under management, they started allocating into Bitcoin last November 2020, with an allocation, we understand, around 500 million. Very interesting. And they're saying in their yearly report for 2021, Bitcoin sits at an intersection of populism, inflation, trust, and money. Very, very interesting words they're using here, okay? And then most recently, only a few days ago, Nicola mentioned Morgan Stanley. Morgan Stanley's wealth management unit confirms that their clients now have access to 2 crypto funds. So it's very interesting. A firm like Morgan Stanley, yeah, they're very creative, they're innovative, but they're also conservative. They are relatively careful about that. And they were saying, of course, that only you have to be an individual investor with at least 2 million of investable assets and or as a firm of 5 million. So we understand it. And they're saying 2.5% maximum for an investment. So this gives us some indication. Then, of course, there are hedge funds. Nicola mentioned the hedge funds. I've mentioned here a third point, Dan Loeb. He's a hedge fund. He owns crypto and is heavily involved. Brevin Howard, the huge hedge fund based here in London. Alan Howard himself is involved as a personal investor, as an owner of CoinShares and others. Then, of course, Tesla. We mentioned Tesla. Most recently, now even pushing Doge, this other coin that went up hundreds of percent in the last few days. And then very interesting here, the New York Life is a life insurance company which put 200 million in crypto, and the CEO is now sitting on the board of NYDIG. Okay, so there's some serious involvement in this crossover that Bridgewater mentioned earlier. From an academic point of view, lots of papers that look at Bitcoin, that look at the crypto market, look at valuations and so on. I've just mentioned a few here. That most recently, the impact of 2020 Bitcoin halving and so on. So a more mathematical, social, and econometric analysis. Serious papers here being written here. In 2018, these authors wrote something, used Gaussian gas models in order to model the volatility because of the high volatility. We come back to that. And then some questions about marginal cost of production to find out what the value of Bitcoin could be. And then, of course, the question here of bubbles and so on. Very interesting papers themselves, not just from a Bitcoin point of view, but from an econometrics and financial markets point of view. So let's now take a look at from a wealth management point of view. Okay, so what are we talking here? We're talking here about a whole range of clients, ranging from affluent clients. That means people who have a few £100,000 or dollars to invest, their pension, their savings, so more conservative, to high net worth individuals, ultra high net worth individuals, and family offices. So we're talking about the 50, 100 million, 500 million, and even bigger. As you know, today, some of these firms are considered private money, but it's managed in a professional way. The second question we need to ask ourselves is this in the regulated space, onshore, or unregulated offshore? The FCA, the UK regulator, when looking at what wealth management firms do, they want to make sure that you focus on the client outcome. Unless a client is offshore, unregulated, or extremely sophisticated and wealthy, where perhaps he can opt out of that. But the majority of the clients, you have to focus on the client outcome. And you need to give them something that serves the purpose. And if the purpose is to save my money for my pension, then it has to sit in their risk categories and so on. And that's a whole discussion in itself. So the question is, where does that sit? So the starting point is, what is really suitable for the client? So you need to go to this attitude to risk questionnaires and capacity for loss and so forth and so on. I mention it here because Bitcoin, as we see in the next slide, is hugely volatile and has got certain distribution characteristics that potentially make it less investable and less usable in a portfolio here. So you need to risk classify your client. Then you need to say, where could potentially Bitcoin come in? And I think it's quite clear from a volatility point of view, it can only be on the highest risk level, potentially, or in a bespoke portfolio where the client says, I don't need your standard 1 to 10, 10 being the very aggressive adventurers, but perhaps a bespoke portfolio because I understand the risk is a certain point and so on. The next one here, as I said, the real question here is, how can I value cryptocurrencies? What is the real value of cryptocurrencies? And as mentioned earlier, Ray Dalio, who thinks the way to look at it is a long-dated option, in-the-money call option, with a strike of probably 20,000, and it's now trading at 50 or 60 or 70,000, whatever. Okay. Another way of looking at it, of course, could be I look at, rather than using a financial option pricing model, I use a real option methodology, and I'm trying to figure out what could be the value be. Another approach. Rafa, which I mentioned earlier, the London-based investment firm, they saying in one of their reports, Bitcoin is valuable because of the inviolable trust. So it gives you something that is outside this system of what I call financial repression, that the central banks have been pursuing for many years, keeping interest rates extremely low, and an erosion of some kind of trust and so on. But they have no model, and they look at the kind of the gold market and saying, as we said earlier from Nicola, that if Bitcoin became part of gold, that would be the market size and so forth and so on. Then there are some very interesting innovative approaches, because the classic corporate finance models obviously are not working. I forgot to mention it earlier, because there are no cash flows, there are no assets and so on. So the traditional model doesn't work. There are innovative approaches here like Metcalfe's law that looks at the future price of Ethereum, similar to Bitcoin, and they're looking at the network value to transactions ratio and perhaps a new ratio, the price to Metcalfe ratio and so on. So basically looking at the nodes and transactions and saying, out of this, I can perhaps extrapolate into the future what the future could be. Interesting approaches. Some people could say, hey, Jacob, this is wacky. I would say we need to keep the eyes and ears open, and you need to think about what could it be. Okay, so the more approaches I have, the better it is. But it's still unclear what is really the value. Okay, so here just some numbers. Okay, because we are finance guys, we need to look at some numbers. And I had some more ideas what to do, but I want to keep it simple. Okay, so here, descriptive statistics, the starting point of any discussion. Okay, so we know that Bitcoin at the moment is around 56, 57,000, traded 63,000 a few days ago and so on. So what's the average daily return? Average daily return over the last 7 or 8 years is 0.28%. But the range is really from minus 37% in a day to plus 25% in a day. So, hey, this is super volatile. From a wealth management point of view, who wants to think about, can I allocate into that? That creates a real problem because the volatility is huge. Okay, so around 70, 100%, something like that. Okay, over the entire period, over shorter periods, it's even higher. Okay, the distribution obviously has got a negative skew because of this minus 37 over 25, and it's got huge kurtosis. That means outliers and so on. That means this is an asset that I need to be aware that has outliers. It can give me outsized returns, but it can also give me huge losses. So when I think about it, adding into the wealth management portfolio, I need to be aware of that. And we ran some numbers most recently and said, what would it mean if I allocated 2% or 5 or 10% into this? The reality is it a diversifier? Is it a volatility dampener, or can it add to returns? Okay, diversifier, I'm not so sure. Okay, and some work needs to be done in terms of correlation and so forth, deeper work on that. Volatility dampener, definitely not, because it does the opposite of volatility. I mean, it introduces volatility to your portfolio. But on a higher risk level for clients, that is potentially what clients want, because volatility is not necessarily negative, as you know. Sometimes it's positive. Upside volatility is something good. It gives me outsized returns and so on. So if I think about, let's assume I want to invest into cryptocurrencies, because even though I'm critical, I need to have an opinion. I discussed it today with my colleagues at the wealth management firm, and we said we need to have an opinion. But when I have an opinion of whether or whether not, because not having any opinion is bad, you need to have to say either yes or no, ideally. Okay, so let's assume we want to say yes. Perhaps there is something, perhaps not now, perhaps in 2 years, in 5 years' time. How do I invest into that? And you see here the different ways of how one can invest. I can invest into Bitcoin, obviously, in blockchain technology, or the futures on the CME. That means it's regulated. Hey, there's no fraud there. This is a regulated market. Crypto funds, we heard Morgan Stanley, ETFs, and then, of course, crypto-related assets like stocks and so forth and so on. So what could it be, crypto in a portfolio? Obviously, it can never be core, in my view. It will never be core unless it becomes so stable, but then perhaps it's no longer an asset. Then perhaps it's something else. It's a store of value. It's a payment system and so on, which we had, which the CBDC discussion is about. So it's probably a satellite, small position somewhere in a 9 or 10 portfolio, so the highest risk portfolio of bespoke. I think it can only be something that contributes to returns, and it's obviously a speculative asset at this point in time. But perhaps I like that, because I like that for a wealth management client who can afford and stomach the volatility, who doesn't need daily liquidity, he can like that and he would allocate into that. So what's my conclusion of all of that? Number one, there are reasons not to invest. The first reason not to invest is Satoshi Nakamoto. Who knows who Satoshi Nakamoto is? Nobody knows, okay? Is it a person? Is it a group? How much of these Bitcoins does he own? And so forth and so on. Secondly, the volatility. Huge volatility creates a real problem for me from an investment point of view. And the third one is the reputational risk. Fraud, criminal activities, and so forth and so on. What are the reasons to invest? The reasons to invest is it gives me exposure to new uncorrelated assets. I'm constantly looking for that because in my wealth management portfolio, I want to diversify away from the stocks and bonds, because we know bonds are trading at 10 years of 30% of the 10-year government bonds are trading at zero negative interest rate. So I don't have diversifiers any longer. Perhaps that is something in that. Secondly, perhaps this reputational risk and so on is declining because now the big players are getting involved and the central banks are getting involved, perhaps not in Bitcoin, but in Bitcoin-related issues and so forth and so on. So what's my conclusion? Number one, you can't dodge the discussion. I hope you get the pun, okay? So I reject the null hypothesis, it's not investable, but it requires a lot of work in terms of statistical analysis. How does it really fit in? Fat tail analysis, correlation of assets, liquidity analysis, and so on. It is not for all clients. It probably needs also more due diligence. Where can I invest into that? And then last but not least, it's really sizing matters. The question is, if I say yes, and I'm close to saying for bespoke portfolios, it is yes. For certain high-risk portfolios, it's yes, but it's all about the position size. And that has nothing to do, by the way, with Bitcoin. That has to do with anything that I do in my wealth management portfolio, because it's all about controlling the risk. So with this, my presentation has come to an end. And I'm now happy to pass back to Elias, who is going to moderate a panel discussion with us.
Thank you, Jacob. Thank you very much. Hope that everyone can hear me fine. I'd like, first of all, to really thank you all and special distinctive thanks to the keynote speakers, to Professor Massimo Bonomo, who is a former UN expert in blockchain and cryptocurrencies and artificial intelligence, and a professor of finance. Thank you very much, Massimo, for coming and sharing your ideas with us. I'd like to thank also Mr. Jim Cunha, who is a vice president and for secure payments and fintech at the Boston Federal Reserve. It's been a brilliant presentation. I'm sure we have many questions. My warm thanks are also extended to Mr. Thomas Moser, who is an alternate member of the governing board of the Swiss National Bank. So the keynote speakers, despite their busy agenda and schedule, they came here to share their experience, their current project, as you have seen with our current students. I would remind everyone that this is an educational meeting. it's an educational meeting. My thanks are to my colleagues who are doing this as an extra too, especially Jacob, who has made this as a fashion. We had brilliant presentations back in December on ESG, and always Jacob following the trend and the tropical topics and crypto CBDCs and Bitcoins are definitely one. And also to Nicola Manuelli. So colleagues, if you don't mind, you can post your questions in the chat. I have seen that we had a question two questions actually from Luca, our former students. Hope Luca is doing great. And Jim has already answered. I can put a question on the table, probably to Massimo, who was the first presenter. And I have a question for Massimo, whether the interoperability is a key to the CBDC success at international level.
Okay. Well, the interoperability issue is quite an important issue because, as we all know, cash is slow to send via traditional borders, thus giving limited interoperability. There is a Chinese proposal for interoperability about CBDCs because interoperability should be enabled between CBDC systems of different jurisdictions. The proposal is of a scalable and overseen foreign exchange platform supported by DLT or other technologies. So in China, the People's Bank of China, PBOC, is engaged in an ongoing initiative based in Hong Kong called Project Lion Rock. This project was initiated by Bank of Thailand and the Hong Kong Monetary Authority to research and study the operation of CBDCs for cross-border payments. Interoperability is definitely critical for the success of CBDCs. Also, IMF stated that interoperability is key to success of CBDCs. Why is that? Because once countries like, let's take, for example, United States or China launch their CBDCs, the tokens will begin to have an additional use apart from transacting within a nation's borders. Because CBDCs from these countries will begin to show up in the digital wallets of consumers also based in other countries, like India, for instance, and they can use these currencies to purchase products in the international markets. And then something very important and to some extent political happens because this opens up international trade scenarios contributing to usage in the retail markets, increasing the adoption of currencies that allow users more liquidity and convenience. So for a CBDC to be successful, it must also be able to interoperate with other payment systems and digital assets, as well as CBDCs. Currently, cross-border payment transfers are costly and subject to complex regulatory hurdles. So it requires more efficiency and less costly transfers for international trade settlements and capital market transactions. Okay.
Thank you, Massimo. Thank you very much, Professor, for this insight. My next question is probably for Jim. And I'll ask Jim, how would you balance privacy? I think you've touched on it on the presentation already, between privacy and the need for compliance, bearing in mind issues of anti-money laundering and CFT, and with the central bank digital currencies.
Yeah, thanks, Elias. Yeah, that's one area that we see as one of the most important for CBDC, which is privacy. I said that different policy questions sometimes are at odds with each other, because the more private a currency is, the harder it is to check for compliance. And here's an area where I think technology can help solve a problem. I mentioned CowPaths. in existing systems. And I think how we do anti-money laundering is a cowpath in that right now it's done by financial intermediaries. It's expensive, it's not very effective. And those financial institutions would rather not have to do it. So here's where we're looking at technology, and can we build technology in a way that we can ensure maximum privacy, and I don't mean anonymity, I mean privacy to the parties transacting, but still catch the bad guys. So I'm not saying it's the answer, but if you look at zero knowledge proofs, there are technologies and various cryptographic treatments that allow you to examine the data to see if it's going to a bad guy, but without seeing it. And if you happen to get a positive result, you then can expose the data to the particular authority. So I think, and zero knowledge proofs are fascinating, but not at scale at this point. So I think here's an area where we can look at privacy and compliance and not have them be at odds. And here's where technology may be able to help inform policy by making the examination of transactions not expose the private data. I think that's one area where we may be able to solve some problems moving forward and create new ways of examining that data. I'll leave it there.
Thank you, Jim. Thank you. We have a question for any of the speakers. Ranin Sakario is saying, in a context of sustainability megatrend, would you consider time currency would become soon one of the cryptocurrencies and maybe part of blockchain transactions? What is your position, Rex, I guess? Time currency, any specialty literature review you can recommend? Jacob or Nicola or anyone?
Look, Nicola, you want to take over? I mean, my comment is, I don't know about time currency, what that is. I know about sustainability. I think there are big issues around sustainability. And as you know, as I mentioned earlier, we are, as a firm, we have sustainability is very close to us. We have sustainability portfolios. And there's this big discussion of whether Bitcoin is sustainable or not, and whether it's carbon and so on. You know the whole discussion, so I'm not saying anything intelligent here. Of course, it would be desirable if Bitcoin and this whole blockchain transaction could be moved to a sustainable level, and perhaps a currency that would then serve that purpose would be very good, because, as I said, our sustainable portfolios are the most successful ones. So I'm giving you now financial advice, which I don't want to do. Joke aside. Nicola, you want to say something about time?
Well, to be honest, I don't know time currency, but well, there are thousands of currencies, cryptocurrencies. But I guess maybe it might be, and this is needs to be checked, maybe something regarding the fact that you volunteer your time and get something back, and so you're not paid by money, but paid with time from people. It's an interesting proposition, but I think it sits more in the kind of crowdfunding charity side rather than a proper currency that can be used at least as an asset or properly as a payment system.
Yeah, I saw in addition to that time currency, so now I understand what the question means. Basically, Nuriya Chakakora, former president of the Minneapolis Fed, wrote an important paper that said, time is memory. You work, you get money, and that money is a store of the fact that you did X labor, which you then spend later by giving someone the money. So it's really time currency in the way it's meant here. And so I think that's one of the ultimate definitions of money. Its value is that it's storing value about the fact that you worked, and the fact that you can then, instead of trading directly, I give Jacob a chicken, he gives me an hour of labor. We have currency as the intermediary. So I think we are doing it with our currency, and trying to think of it in context of CBDC, I think, or cryptocurrencies, I think, are only a positive way of framing what a currency actually is.
Excellent. Thank you. I think we're going back to economics basics of defining the currency. It's a medium of exchange. Time is definitely could be a medium of exchange. It's universal, it's transtemporal, and it doesn't change over time. So the time is the time and is unique around the world. I have a question for Tom, who is an economist, and I hope that I could be one of these economists. Thomas, do you think that there is a serious demand, global demand for CBDC? If yes, what is, in your view, what the characteristics? What are the characteristics of that demand? Is it uniform demand? Is it stable? Is it time varying?
Yes, thank you, Eliza. I think there is a huge demand, actually, not for everyone. I mean, not for the people who want to basically build an alternative financial system without banks, without central banks. But if you look at the blockchain ecosystem and at the cryptocurrencies, what we have seen over the last, especially 3 to 2 years, is a huge rise of stablecoins, which means that there are digital currencies needed that have a stable value to be used as a means of payment. Nicola and Jacob talked about investments. So Bitcoin, as a speculative investment is one thing, but if you want to actually use one of these currencies as a payments then you need a stable value. The interesting thing that I see, even though you have very different stable coins, going from stable coins backed by traditional assets to stable coins backed by crypto assets to stable coins not backed by any assets, purely algorithmic, all of them, or almost all of them, peg their value to the US dollar. So there's a lot of confidence in the Fed. There's a lot of need, apparently, for something pegged to fiat money. And that would suggest to me that a CBDC would actually be a killer app for the blockchain ecosystem.
Excellent. Thank you very much, Tom. Very, very interesting. I have another question, if you don't mind, probably for anyone, actually. It could be for you, Tom, or Professor Bonomo or Jim. How will cryptocurrencies interact with the existing monetary regimes and central banks that can administer them?
Maybe I can jump on it. The interaction between CBDCs and cryptocurrencies is quite an interesting one, because as we know, the launch of CBDCs is also aimed at reducing risks associated with the cryptocurrencies like Bitcoin. And then we come to the specific and very important issue, which is centralized versus decentralized cryptocurrencies, which in the first case would be like the likes of CBDCs, and second case, Bitcoins. Now, the point is that privately issued currencies such as Bitcoin, Doge, Tether have been capturing a large amount of market share over the past year. Now, if central banks do not keep up with digital currencies, they might be left behind in the race. The issues about cryptocurrencies are very serious as well, because crypto assets have been defined as highly volatile, therefore not very useful as a store of value, and they are not backed by anything. Also, in South Korea, for instance, the South Korea central bank chief said that the CBDCs will reduce demand for Bitcoin. This is a questionable point, because CBDCs are like a fiat currency and will meet the requirements for legal tender as opposed to privately issued cryptocurrencies. A question that I would like to ask to the audience, to Jim and Thomas, for instance, is do it right or do it first or do it fast? My answer would be do it right, but not too slow.
Yeah, I'll quote my chairman, which is always a safe thing to do for a central banker. And he has said, it's not a race to go first. This is not about first mover advantage, but it is about getting it right. Because the opposite is true. If you go first and get it wrong, the consequences are catastrophic. Because as I said many times, the US dollar is not low-hanging fruit. It's not what you play with and experiment with. So I think you have to get it right. There's a question from Luca on attack, or I paraphrase it as attack from nation states or bad guys. your platform has to be bulletproof because it will be attacked as much as a nuclear facility. So getting it right is critical from systemic importance, but also from people having faith. You know, imagine having a currency that you lose faith in. Well, that's by definition a bad thing. So it's getting it right, not first.
Absolutely, I would absolutely agree with Jim. This is the most important thing, not to mess it up and lose a reputation, which is a very important value for a central bank. Maybe one issue to follow up on Massimo. You know, the point is, as he made, I think it's also important to point out this is not an issue of privately issued money versus state money, because we already have that. So commercial bank money is privately issued money, but it's in the same denomination as the central bank money. And what Bitcoin does, it's something totally new, a different denomination, if you want, so that the issue that you have there is more akin to what you usually call dollarization or euroization in some countries where their own currency disappears and then the dollar is used or the euro is used. So I think this is some of the concerns, some of the countries that, for instance, Libra has been mentioned, that if they would have come as originally intended with their own currency, you know, that you could have similar problems that you have with dollarization now in some of the emerging countries. But that's also nothing new. You know, it's just a different form of the same old problem.
Thank you.
I 100% agree with Thomas. This is an issue that Libra is being called as a wake-up call for central banks to be active and to interact as quickly as possible. But of course, you have to get it right. The concept of being right is also questionable to some extent, but also not to be too slow, because otherwise some like Central Bank of China has done with DCEP is a step ahead, and that might give some problems in the future for the other currencies.
We have if I may jump in, we have here two chats. One from Victor Rosenberg. As government-issued money is very susceptible to diminishing of purchasing power, would cryptocurrencies be able to diversify some of the systematic risk existing in modern portfolios that is not related to central bank activity? Nicola, you want to comment on that perhaps? Or anyone else? I'm happy to say something about it.
Yes, absolutely. I think that, as you mentioned, we need to study a little bit more the correlation, but now we're starting to have a decent amount of data about the way Bitcoin has traded. So unless we think about a change of regime, we can look at the correlation that it has with the other assets, and like we do with basically diversified portfolio, understand how much risk this adds. And if it's really uncorrelated, like it seems to be, because it has its own reasons to move, the rumors and the forking or not, and the other things that happen in that ecosystem, it might be completely, volatile, but completely unrelated with what is happening in other assets like the Standard & Poor's or the government bonds. And so from that point of view, it might have a very high volatility, but from, let's say, from a CAPM point of view, actually a return that is higher than what it would be required for the risk that it has to portfolio. Of course, I don't have the calculations with me now, because you need to do some more study, but it could be a way to diminish the systematic risk of a portfolio, like you mentioned. Yes.
Nicola, I do have the calculations. It's in a paper with a colleague of mine of the Swiss National Bank. We will present it in 1 month. So we have actually, there are some interesting results in there that there are really different performances depending on the actual design characteristics of the stablecoin. But I will send you, as soon as I can send it out, I will send you the paper. But it's a very interesting question.
Yes, yes, please, absolutely. This is one of the most interesting questions now that proper private banks are starting to considering it, for example.
Exactly. Elias, any other question?
I have 2 or 3 questions. That goes back to the innovation and to Jim. So in your view, Jim, will central bank digital currencies, will they inhibit or promote innovation locally or globally?
Yes, so I personally believe that it'll cause the growth of innovation. Much like no one understood the value of the World Wide Web early on. We thought it was sharing cat pictures. Now we realize it's about commerce, it's about trade, it's about so many things. I think if we do create a digital currency, a CBDC specifically, I see plenty of opportunity for innovation. So for instance, one particular example in the States is, we have a problem with unbanked and underbanked people. Somewhere about 6% of the US is underbanked, and another 20% or so are underbanked, meaning they have bank accounts, but they're using check cashers and pawn shops and things. Well, you can see a scenario where someone can hold a CBDC and create a new way of someone who doesn't have a bank account moving money. And because money can be held by anybody, I can see, a private enterprise or a startup or an innovation that holds CBDC, provides services to the unbanked. That's not a policy statement. That's just, here's a problem to solve, and there's some innovative ways of doing it. There's a debate amongst many central banks on, do you make smart money or not smart money? I believe you don't make smart money. I think money should be a utility that has very little function, storing value, moving value, doing it safely, and let everybody else innovate. So if I want to create smart money to stop me from doing something stupid with my money, I'll buy a wallet that has technology in it that someone builds that stops me from spending money I shouldn't spend, or from spending money that's supposed to be for food, for non-food, like food stamps related activities. So I think there's plenty of room for innovation over on top of money, and we should not complicate the money itself by trying to make it smart. So a couple of different topics I'll put in there. And whether that's smart contracts or just software in a wallet, or some creative organization that figures out how to solve an existing problem like the unbanked or cross-border, I think this is plenty of opportunity for innovation on top of a CBDC.
Thank you, Jim. I think you're reminding us, very wisely, the conceptual framework and the fundamentals of what is a currency, of its mean of exchange and unit of account and storing value, and that is quite important. And that's why I think you've debated this, but frankly, colleagues, maybe Tom or Massimo, how important is the issue of privacy for central bank digital currencies and traceability on the other side? So, when we talk about privacy, yes, but what about traceability, and what is the balance in your view?
Well, maybe if I start, I think it's a very important issue. Jim already touched upon it, and he also talked about the ways that technology can bring very new ways to protect privacy. But I think it's important because it's a very basic individual right, but also a very important social value in a free and democratic society. So I think it's very important that we get that right. That on the one hand, that we make sure that the CBDC, doesn't give tools to the government or to the private sector interest to track everything that you do with money, and to take advantage of that, that you have your space, your private space. At the same time, of course, it's important that this privacy is not abused, and that we need to somehow make sure that it's compliant with the law, and that's where technology can come in. But it certainly shouldn't. A lot of technology that we have enjoyed over the last year has been great, but it clearly has been an intrusion to privacy, because a lot of times the thought about privacy came afterwards. And I think it would be important that when we do a CBDC, that we start with the thought of privacy already at the beginning, and that's also part of getting it right, as Jim said.
Thank you.
Okay, about privacy, this is an issue I've been looking for some time now, and I think the crucial issue is that full anonymity or full disclosure. My opinion would be midway solution where system designers have a set of choices about the kind of information to keep it private and who to keep it private from. My solution would be finally a matrix scheme. On the column we have we place the kind of solution to keep it private, and on the lines who to keep it private from. And then, of course, we evaluate different privacy models. Depending on the choice of the central bank, a particular set of privacy solution is adopted. In the matrix scheme, some rules should be applied. We should exclude, for instance, some solutions because they might lead to high operational costs and excessive complexity and risk. There should be a minimum set of privacy for users, an opt-out solution for the user's overall privacy, depending on factors such as user behavior and preference. The question is, I would ask to the audience, is also CBDC is supposed to be a replacement for cash, right? Now, cash is anonymous. CBDC should be too anonymous to some extent, because cash-like privacy for CBDCs does not comply with KYC and AML regulations, because it risks include hidden vulnerability, a lack of scalability, and complicated operations. A possible solution would be a ceiling for the CBDC transaction above which privacy is not guaranteed for KYC and AML concerns. In fact, in China, the Chinese CBDCs has 4 wallet types with increasing transaction limits allowed. There is an anonymous version that allows a maximum of 500 yuan per payment, a daily limit of 1,000 yuan, and 10,000 yuan per month. These sorts of wallets can be opened with just a mobile phone number. But phone companies are not allowed to share real names and other personal data with central bank by law. Hence, these wallets are entirely anonymous to the central bank. Of course, if we engage in more complicated transactions, KYC and AML must be addressed. Also, a last point is about e-commerce transactions, because payments are made to e-commerce platforms such as JD.com via a sub-wallet in China, which means that the platform does not access personal information or transactions that are made by the main wallet. This is the point about privacy in for CBDCs, in my opinion.
If I can add just 2 more points to Massimo's, I agree in the potential for a de minimis amount to maybe have a different privacy profile. But I'll also quote one person, I forget internationally who said this, but if someone tried to create currency today, paper currency, it would be deemed illegal for many reasons. Maybe it was a Swiss or Sweden that quoted that. But also an economist inside the Fed, I wish I remembered who it was, said, why would you, this is one of the cow paths, why would you create a new product that tries to mimic something whose sole being is because it's a piece of paper? Why would you think that a characteristic of paper is something that in the future is by default a design option you need to have? So I'm not saying you shouldn't have some strong privacy, but just because paper currency is anonymous today, does that mean that something that's going to last for the next 100 years in the US or 350 years in Sweden should have the same characteristics? Or should we fix some things?
I think it's interesting from a UK perspective, as you heard, that the Bank of England are now looking at, the government are looking at central bank digital currencies. But we have a very strong sense of privacy here. People don't like to be registered here. There's a lot of opposition to the apps, the NHS apps to track you and so on. So I think it's going to be a hell of a job for whoever is going to design that here in the UK, because we just don't like it. It was one of the reasons why we wanted to get out of Europe and so on. So I think this is going to be very difficult. On the other hand, there's a strong sense that we should do it. So very challenging from a UK perspective, I guess.
Yeah, and we are working with jurisdictions that will have different answers. So
exactly,
I'm not saying my answer is right, but I do think that we shouldn't just presume the current way of doing something is the right way. But we know there's different models. And most importantly, those models will evolve. As you know, with the GDPR, things change that you need to have a currency that can change and be flexible enough to handle new norms and handle new laws that come into being.
Thank you, Jim. Thank you, colleagues. I think you've left us on a very nice question, things to think about, and inaction in itself is an action, and a lovely statement for the audience. On my side, I don't have any more questions unless somebody from the
Elias, I have one more. I received one in a private chat here, which might be quite interesting, from a colleague of ours, a guest speaker at the university, Patricia Albers, who comes on a regular basis. And she's a trader and the chartist and so on. And she asked as follows. She says, what the panel thinks about US regulations leading potentially to more volatility in the crypto market or less volatility. We know the regulations are coming and that is something that is potentially necessary and so on. But will it lead to more volatility or less volatility? Who wants to cover that?
Maybe.
Well, I'll just say that I won't cover it. It is interesting, but I don't pose this facetiously because I think these things are so complicated. Sometimes whatever we think will be wrong. But I also wonder, would the issue of a CBDC have any influence on cryptocurrency volatility or not? And I think that's another very complicated question. It gets to what Nikolai and Jacob, you talked about as far as the current market. If you add a CBDC, what does that mean? So anyways, I'll stop there with the question to the question.
Thomas?
On volatility and what influences it, I would also pass on that. That's very but one thing about regulation, because in Switzerland we have also Crypto Valley, a lot of enthusiasts of blockchain and alternative financial systems. When I talk with them, one issue is it's not, sometimes regulation is seen as now the bad government comes in and starts to restrict stuff. But a lot of times the experience you have is that, first of all, you have customers who want regulation because they want to have some security, some safety. They want to be sure that it's not a fraud. So they are demanding often regulation. At the same time, from the entrepreneurs, if you want to make an investment, a lot of people want to have some legal security there. And so there's also from a lot of companies coming requests for regulation. There are some very popular stable coins where the issuers ask for regulation and actually use that to promote their stable coin. So it's a mixed thing. So there is a lot of demand for regulation, but of course the trick is to get it right and not to stifle innovation.
Yeah, sometimes regulatory uncertainty is worse than regulation.
Yeah.
Now, I also agree with what Jim and Thomas said, because regulation gives stability to the market. And if the market is uncertain about what's going to happen because of lack of regulation, that could increase volatility rather than decrease it.
Exactly. I think we're coming to an end. What I would like to do now is I would like to ask now Shai Bibilashvili, if he's still with us, who is deputizing for the president of the student union, to say some final words. Shai, over to you. You're one of the students. You're deputizing for Pascal Sen, who unfortunately is not feeling well, but it's over to you. Some final words from you, please. Thank you.
Right. So, like Mr. Jacob Schmidt said, I'm talking in my name and the name of Pascal Sen. First of all, I would like to thank all the organizers, and in particular our three keynote speakers, Mr. Jimmy Cunha, Mr. Massimo Buonomo, and Dr. Thomas Moser for your time and contributions. Thank you very much for that. Nevertheless, I would like to mention on how important education about crypto and blockchain is nowadays. It is also impressive to see how many diverse applications a technology like blockchain has and how our generation is at the forefront of advancing these technologies. And really, Regency is an excellent example of a university that is actively teaching new technologies and financial systems. And such events like today help our community grow bigger and think critically about the future as tomorrow's global leaders in the space of crypto and blockchain. Thank you very much.
Thank you very much, Shai. Thank you so much. So just some final words from me. I think that's all we have time for today. As mentioned earlier, if we were unable to answer any of the questions today, any of the delegates can send in emails. We would be happy to answer to pass it on. A recording of this call will be available later, so please look out for that. Thank you very much again to all the speakers. It was thought-provoking, interesting, stimulating, very good spirit. Thank you very much, Shai, and the students from your interest, but the wider community, of course. And that really brings our webinar to an end. A great working with you, and I think the future is crypto or cryptic. With this, we bring it to an end. Thank you so much, everyone. Have a nice evening and stay safe and healthy.
Thank you.
Thank you.
Thank you. Thank you very much.
Thank you very much. Bye-bye.
Bye.
Bye-bye.
Elias, I think you can finish the call now. Thank you very much, everyone.
Thank you, Jacob.
Thank you. Have a great evening.
Bye-bye. Bye-bye, everyone.
Bye.
Thank you, everyone.